Hey everybody, this is RC Peck, and this is my weekend video podcast thoughts, ideas. So I'm going to start it with an interesting fact, and it comes from Lipper Investments. And they said on Thursday that more than $25 billion from equity funds were pulled this week. Now, this came out on Thursday, so there's still Friday. So what they're saying is this is the worst week in 17 years. So you got to go back to 2002. Think of all the time between 2002 and 2019. And this is the second worst week for people pulling money out of their equity funds. Pretty scary. Pretty scary. And the reason is, I'm going to actually get to it, but it's not going to get any better. So let's talk about what's going on this week. So the first thing I want to show you is this slide from the chart report. And it is 8 10-year yields. The US, Japan, Canada, France, Switzerland, Australia, Germany, and the United Kingdom. Now I'm going to point them out to you. So this one down here, this green one, that's Switzerland. You give Switzerland your money for 10 years, they're going to keep 88 basis points a year, and eventually you'll get the rest back. Germany, a little better. That's the red line. They're going to keep 0.5%, a little bit more than 0.5% a year. France is going to keep 26 basis points. And oddly enough, Japan's looking pretty strong at only keeping 18 or 0.18% of your money every year. These are major economies on the planet: Japan, France, Germany. Now, Switzerland's not, but Switzerland is known for as a safe haven. So it has important resonance with me because, man, they're going to keep the most. You have 4 major countries that have negative 10-year yields. Now, above them, racing to the bottom, is Great Britain, Australia, Canada, and way up here, the black line is the US. So I show this to you because if you want to know why the Fed is really lowering rates, it's not because of unemployment, and it's not because they're protecting price. Okay, it's because all the other countries around the planet are lowering their rates. And if the US keeps their rates, now, just so I'm clear here, the US, that the Fed is not lowering the 10-year treasury. They're lowering the federal funds rate, which has the effect of lowering the yield on the 10-year treasury. But if you want to know what's really happening is the Fed is now basically following Germany. And I'd say more than Germany than Japan, because Japan's negative yield has stayed fairly flat, right, for the last year, and it's been Germany's that is accelerating to the downside. On the screen, Germany is the red line, so Germany is accelerating to the downside. So if you want to know who's setting the federal funds rate, it's Germany. What you can also glean from this is rates are probably going lower. Now, they're going to go lower every week or every month or every quarter? Probably not, but they're going lower. Okay, now, here is a great chart from, I don't even know how to say, chartr.co. And this little dot right there, if you can see right behind my crosshairs, that was the fall or the drop on August 5th. U.S. stock market fell 3%. Now, what's neat about this chart is it visualizes every stock market day's return for the last 10 years. So you can see most stock market returns for a day are plus or minus 1%. You have a crazy one over here where the market fell 7% in one day. And over here, the market went up 4.9% in one day, all within the last decade. So what's interesting about this is this little dot right in here this week, plus a couple other dots, had people pull more money from their equity funds in the last 17 years. There was just one more time where investors pulled more money than they did pull this week. Pretty crazy. The theme you're starting to hear or notice is you've got to have a plan. You've got to have a strategy. You got to understand your beliefs and your biology and your biases and your behavior. The problem is it's in your blind spot. And it doesn't matter how many books you read, what your IQ is, what your income is. You need someone to actually pull out your blind spot from behind and show it to you. If you drive faster, you don't get to see your blind spot. If you drive for years, you still have a blind spot, right? So you can be 50 years old and know all the jargon and have been invested in the market for 15 years, but you still got a blind spot. Okay, I thought this was kind of funny from Steve Burns. He says, here's a list of all the lessons the federal government and big banks learned from the 2008 financial meltdown. And then he lists the 10 of them, and of course, they're all blank. I thought that was pretty funny. I don't really think people have learned much. I mean, this is about the federal government and big banks. I agree they're going to get hurt again. But I don't notice a lot of learning from investors either. And that's it. It worries me and also makes me sad. You've heard me for years say this. If you've been in my world for years, I often say that women are better investors than men. And it's a shame because women often, they don't do the investing in the house if they're married, right? Or when they go in to see their advisor with their husband, even if they set up the meeting, even if they pushed and prodded and cajoled their husband, dragged their husband into the meeting. Isn't it weird that the advisor looks to the man and says, so what can I do? How could, whoa, something very weird is going on here. This is a call out to women to get trained. I'm biased. I think you should get trained with my training, the training for the intelligent investor. But women are very good. They're much better at investing than men. There's a lot of reasons for it. I won't go into them, but this is just kind of a call out. And I saw this image this week. The rooster crows, but the hen delivers. And when I've worked with couples and the woman has been brought in to the financial conversation, great things happen to their money. Okay, I built this little one this week. So what you're seeing here is a price chart. Okay, it's a couple days old. It's August 2nd. What I want you to get is bad stuff or scary stuff or things sounds really, really scary where the red line is. And I could have put, a red line over here too for 17 and 18. And really good news happens down here. And this is how it's always going to be. This is how it's always going to be. Scary news, good news. Scary news, good news. Scary, scary, good, scary, good, scary, scary. Good, scary, good, scary, scary. This came down and is back up. Training your brain, rewiring your mindset. A lot of people nod to it. They nod along like, yep, but very few ever get trained. And when they don't get trained, what happens is people are inundated. People are slammed with very scary words. Now, what I love about this image is it shows images and not words. But what is really happening is this person, you, me, when we read something, our brain loads up images. Imagine what's going on in the brain when you read newsletter headlines and ABC News headlines and CNBC and Bloomberg and any of them. It loads up very scary images and then you do very scary things. And that's not good. And I will say right now that you're about to get a huge onslaught in your inbox about currency wars, because this week, one of the reasons why the market fell 3%, was that Monday? It already feels so far away, is because China devalued their currency by 28%. Okay, I'm kidding about the 28%, but that's how it came across. Like, oh my gosh, they devalued their currency by 28%. It was actually 2.86%. Yeah. 2.86% they devalued their currency. So look, Trump can have his tweet and, he can have that thing. China can have their currency. So, the trade wars are happening. The currency wars are happening. Gold has woken up. Over the last year, gold's up about 22%. The stock market's up about 3%. So gold has absolutely woken up. But there's a better way. There's a way that you can filter out the noise because you're about to get hit with dozens, hundreds of headlines and newsletter pitches about the currency war coming and how your account is going to suffer because of it. Guys, there's a better way, right? Going back to this price chart I showed you here before. Here's the price chart of the S&P 500 with dividends reinvested via the ticker symbol SPY. Right? There's a way to keep your money on the black line when you're supposed to have it on it. And there's a way to step aside when you're supposed to step aside. And one of the ways is learning. One of the ways to build a filter is to learn how to take words and put them into conscious images so you know what's actually going on. So it's not even done. I'm recording this with the week not even done yet. You'll get this on Saturday. And already it's been very crazy. People are worried. People are scared. They're getting more scared. That's why you see bond prices and bond price volatility going up higher than stock volatility. Literally, the volatility is going on in the bond market. Now, you don't see this and we don't see this and I don't see this necessarily because we don't think when bond prices go higher, that's volatility. But it is, because when the price goes higher, the yield goes lower. And the yield on the 10-year is getting pretty close to that 2012 and 2016 low of about 1.4%. So volatility is here, and you've got to have a plan and a strategy and a way, right? So your beliefs and your biology and your behaviors and your biases don't stay, the ones that work against you don't stay in your blind spot, but you bring them out and say, let's figure this out. I want to be a great steward of my money for my cause or my community or my family. All right, guys, thanks for being in my world. This is just another step in helping you protect and grow your money. Until next time, this is RC Peck.